Bismillah Rahman Rahim. Hello to all financial management students. I hope all of you are doing well. Hussain Qazi here. A very warm welcome to this financial management practice question session. Agenda. Very specific agenda. A practice question. There's a practice question that's named Gemgee Company. That's named Gemgee Company. Exam attempt March, June 2024. So with this session, we will not only practice the question, but also support you people what is the right strategy to attempt the section C type question, including the guidance about calculation part and the guidance about theoretical aspect, the drafting. The drafting technique. I know that that's very horrible, you people, about how to draft answer. But make sure that you people are covering or you have already covered the theoretical reading content from book, from my notes, and also practice the section 3C type question with my advice. So with this particular session, I will further emphasize you how to attempt section C type question and very particular question that is about Gemgee. So let's start the question Gemgee. Students, Gemgee question, it's more about the business finance and examiner adding here the business valuation content as well. Business valuation means here equity valuation role by price earning ratio plays also the role. So section C type latest question, although broadly one syllabus area, that's business finance, but also added one more syllabus area, that's business valuation. So let's start the question. Assuming that I am a student and this is what the exam question, I'm sitting with the examination hall. So, and I opened the section C type question and where the screen particular mentioned this. So first of all, you need to quickly refer the requirement part, right side part, requirement, where very quickly you will be able to find that's what is about syllabus, what is about the question related to syllabus area. Section C type question examiner can ask based on previous analysis, investment appraisal or business finance, either debt or equity matter, these complications, or the WACC and the working capital. Here, very categorically, you have identified that's ratio, that's business finance, all these things. Okay. Number one. Number two, for business finance, it's not the question, it's about the WACC. So first thing you need to identify this. So first part, that is something about 443. That means it's, yes, that means it's 11 marks. So what's next? Theoretical part about the finance gearing. What's next? 4 marks something Islamic finance. So very important. Part B, C, 4 plus 3, exclusive theory. And part A is a mixture of calculation and theory. And if we identify the total numbers here, so 10 marks it's about calculation, 10 marks about theory. 10 marks calculation, 10 marks theory. 10 marks calculation, 10 marks theory. 10 marks calculation, 10 marks theory. That's a point. 10 marks calculation, 10 marks theory. So student, for 20 marks, For 20 marks, how much time you have? Assuming 1.8 minutes each mark, everybody knows that. Out of 180 minutes for 100 marks, you have 1.8 minutes for each mark. If I multiply with 20, so you have 36 minutes. 36 minutes. For 36 minutes, make sure you need to split your time 20% with planning and 80% for execution. 20% planning means out of 36, it's approx 8 minutes for planning, and remaining 28 minutes out of 36 minus 8, so that remains 28 minutes. 28 minutes for execution. So for 28 or 28 minutes, make sure 50% time you need to invest for calculation and 50% time you need to invest for theory. So number one, my advice, 20% time you need to invest for planning. Number one, before completion of plan, you don't need to start the section C type question. Even this apply with all the paper as well. 20% planning includes three things. Number one, the very first, reading. Number two, understanding. Number one, reading. Number two, understanding, requirement and content. Number three, brainstorm. Before attempting, brainstorm the key points, either for calculation, either for theory. That's the part we have already discussed with the previous sessions as well. Number two, the second important thing. Once you plan your question, then start execution. You have to allocate the time for execution. Here, 20 marks question, 10 for theory, 10 for calculation. So make sure after 20 minutes, you have remaining 28 minutes. By 14 minutes, you have to complete your calculation, and remaining 14 minutes invest for theory. So after this advice and after this video, for rest of the questions, you have to invest or you have to practice your question with that particular advice, whatever I'm suggesting you. The first advice I have advised you, that's the time management, that's a planning and execution. Student, can you please apply me? Is this clear? Can you please apply me? Is this clear? Thank you very much. So let's start the first thing. Implement that particular strategy. Number one, requirement, part A. The question, requirement, quickly. To aid its decision regarding which finance option to select, Board of Directors wish to see the impact of finance option following ratios. Very quickly, ratios, interest cover, EPS, gearing. Here gearing, don't forget, here gearing is about market values. Here's gearing about market values. So three specific ratios, very commonly based on the past papers: interest cover, EPS, gearing. A1 requirement, calculate the above ratio, assuming the finance by debts, loan notes, option 1. Calculate the above ratios for the next year, assuming the project is financed by equity, option 2. It's a very common question examiner examine with the same aspects based on past papers. Using the calculation from 1 and 2, briefly comment the result and recommendation, which source of finance Gemgee company board of directors should consider. That 3 marks for commenting. So let's read the question. Gemgee, now read the content. Based on the requirement, the ratios, financing by debt or equity, and commenting. Based on that mindset about the requirement, now read the content accordingly. Gemgee company is a large listed company which has a diverse range of operations. Current information about Gemgee is as follows. Current year operating profit $177 million. Currently debt 6% bank loan 450 million. Equity issue of issued shares 800. Number of shares. Corporate tax rate 20%. Earning per share 0.15. Interest cover 6.6 times. P ratio 8. 8 times 8. 8 multiple. Total gearing measured debt over debt plus equity. Here need to measure gearing debt over debt plus equity and market values, not the book value. If it's mentioned the market value, that means we also need to work with the market values. 32.3%. That means current ratios are given. Current ratios are given. And what the question about? Growth in profit has declined in recent years, and Gemgee company large institutional shareholders are insisting that board of directors undertake an expansion plan. Expansion plan. The board of directors developed a plan which involves project finance 360 million. Project finance 360 million. Initial investment, earning and operating profit. Operating means PBIT. Operating means PBIT. Expansion finance. Gemgee company does not have sufficient cash reserves to finance the project. Does not have sufficient cash reserve to finance the project. Therefore, two financing options are under consideration. Two financing options are under consideration. Option 1, 5% loan notes for 10 years. Expected to trade in nominal value. Okay. Number 2, rights issue, equity shares, 25% discount. Rights issue, 25% discount. Rights issue, 25% discount to current share price. Whether finance option is chosen, whichever finance option is chosen, the following are assumed. Finance will be raised and investment undertaken in time for the project to be operational start for the next year. And the P ratio will remain changed. So this is about the background and the context. So whatever you have read based on requirement, now it's time to read one more time to read requirement and fix your mindset. Fix your mindset very clearly. We need to calculate three ratios: interest cover, EPS, gearing. So calculate the three ratios assuming finance project by loan notes. Calculate the above ratios next year, project finance by rights issue. Very common questions. Regularly examine with these points. You can find with your past paper in the revision kit almost 2-3 more questions like this. Using the calculation from above 1 and 2, comment, briefly comment and recommend. There are two things. Do remember this and is very important. Comment and recommend. Comment and recommend. And this and is very much important. This and is very much important. Comment and recommend. And the 3 marks for comment and 2 marks for recommendation. Comment, one comment is about finance by debts, one comment is about finance by equity, and recommend 1 mark, sorry, if it's 3 marks, 1 mark for comment with finance by debt ratio. Oh, finance by loan note. 1 mark 1 marks comment for finance by rights issue, and 1 mark for recommendation. That's about the reading point. Once you have read it, now it's time to make a brainstorm. First is about the calculation. First is about the calculation. The calculation part. And the calculation part is about part A. Now, before starting the question, the important thing is that develop your mindset. What will be the right strategy that you will penetrate with the working? Right strategy. Very first thing, whatever you understand, brainstorming means here, the first thing, whatever you understand with the requirement, you need to portray the requirement. If I say that I'm going to portray the requirement, so it's very simple. Part is about the situation that's current, that is about the now with debt finance and with equity finance. We need to calculate, or we need to work out with the ratios. That's interest cover. Number 1, interest cover. Number 2, earning per share. Number 3, gearing. Now that is given 6.6 times current earning per share $0.15 and the gearing ratio 32.3%. So if I say that, what is the requirement? What is the point of requirement? So you say that, sir, very simple. We have to work out for these data. We have to work out for these data. We have to work out for these data. All we need to fill this. All we need to fill this data. So this is what about the requirement. Make sure that you are good with respect to the formula. For example, you need to aware about the interest cover. That is about PBIT. No need to mention. It's no need to mention, but only about to recall your or emphasize your workings. Emphasize that point that you will not actually make any mistake. EPS, that's profit after tax divided by number of shares. Gearing here, debt over debt plus equity, and all about book value. Market value. So that's the point. This is what about the question. So this is a time for brainstorming. First of all, brainstorming. So first thing is about brainstorming. Whatever the requirement is, you have to portray the requirement in this way. Okay, that's what we need to do. Second thing about the brainstorming, you need to brainstorm and develop a sketch. Develop a sketch how you will penetrate with the question. How you will penetrate with the question. How you will penetrate with the question. How we will penetrate with the question. Okay. What the information we required or we need? We required PBIT. Okay. PBIT is a P&L. After PBIT, that's interest. Okay. After that, tax. So that means it's a complete P&L. So information about the P&L for interest cover and EPS, PBIT to profit after tax, the complete P&L. Then we required number of shares and also we required debt and equity. So why not to work with this manner? No? All these working, we have to base the working of these PBIT, interest, profit after tax, number of shares, debts and equity, all these information. So let's start with this. No? So what the sketch in your mind? The sketch in your mind that we have to place all 2 points, debt and equity at one place and find out the numbers of P&L from PBIT to profit after tax, then number of shares, then debts and debt over and equity. So just jot down the things at one place. That's a sketch in your mind. Now with that sketch in the plan, you have to implement it. Now it's time to implement. So first thing is about PBIT. Now come on. For PBIT, now PBIT is given. That's 177. 177. Now either debt finance or either equity finance, operating profit will not change. Not change means that will move in a same manner. If says here says operating profit is 64.8, that's earned new investment adding 360 million and the earning will increase 64.8. So either debt finance or either equity finance, that will remain same. It's very simple. Either the debt finance, either the equity finance. PBIT will move in a same manner. But yes, debt versus equity, the things will move based on the financing. For example, the interest. For example, the interest. Right now, the interest. Right now, the interest. That's a loan 450 million and debt's bank loan 6%. So is equal to 450 into 6%. But with the equity finance, if you go with the equity finance, the interest remains same. That's 27. But with this, if you move toward the debt finance, that's 27 plus the new debts 5% loan. New debts 5% loan. New debts 5%. 5% multiplied by total value 360. 45. PBIT interest, that's 2 you have done. PBIT interest. So if you have done that, you can work out easily. PBIT divided by interest. 5.37. Same. Control C, Control V. 11. Sorry. 177 plus 64.8. My mistake. Sorry. So 241.8. So that is 8.96. So very clear. You have a mindset that not the numbers game, but also the commenting. For debt and equity finance, if we move towards the debts, new project with debts, so that means interest cover ratio become decrease. Although interest increases, but the profit increases more than the interest ratio. That's why interest cover become reduces. But I'm sorry, I repeat my words. I repeat my words. I'm sorry. Interest cover ratio become decrease. That means the proportion of interest increases at a higher rate as compared to the proportion of profit increases. So overall interest cover decrease. On the other hand, with equity finance, that means no interest. That means no interest. That means no interest. That once a minute. Apologies. Once again, in with the case of debt finance, interest cover become reduces, and with the case of equity finance, interest cover, the ability to pay interest increases. Okay, now move on with the next phase. After this, the next point, the profit before tax. It's very simple. 177 minus this. That is about profit before tax. That is 150, 196.8 and 2144. After that, taxation. The tax is about 20%. Here question mentioned the 20% is equal to 150 into 20. Make sure that should be in minus 42.96, and that is about profit after tax. Profit after tax. Then number of shares. Right now the number of shares 800. Here mentioned that's 800 number of shares. In case of debt finance, no change in equity. That means no increase in number of shares. But the point is that you have to make some working. You have to work out for this some workings. Now workings, what are the workings? Working is about share price. Working is about share price. Here you need to work out for the share price. Why you require the share price? Because of that 800 finance required with the debt finance. But the point is that how much number of shares? Here is mentioned that rights issue of equity at 25% discount to current share price. So the point is that there is no information is about current share price. No information about current share price. So that's why we require to calculate share price. But is there any clue about the share price valuation? What I said, share price valuation. Yes, share price by P ratio. That means EPS multiplied by PE. EPS multiplied by PE. Multiplied by PE. EPS multiplied by EPS multiplied by PE. Okay, so now, what about the now? Now EPS is 0.15 given, 0.15 multiplied by PE ratio is 8. It's very simple. 0.15 into 8. 1.15 into 8. It's a now price, 1.2. So that why we can calculate is equal to the finance required 360 million. 360 divided by 1.2. So that means existing we have 800 shares plus 360 divided by 1.2. 360 divided by 1.2. Sorry. Now, and we offer 20% discount. 20% discounted. Yes. Rights issue with 20% discount. I'm sorry. Rights issue with 20% discount. And the discount price is equal to 0.8, 0.96. That is about 0.25% discount. I'm sorry. 0.75, 0.9, 0.9. So that means 360 divided by 0.9. That's equals to 1200. So this is a number of shares. Now we need to calculate the EPS. EPS is profit after tax divided by number of shares. 0.2. You can drag 0.14. So here is this. If you compare debt versus, if you compare now with debts and now with equity, now interest cover with debt finance 6.6 and with debt finance decrease till to 5.37. But EPS will increase 0.2. With respect to equity, from now 6.6, interest cover increases. But on the other hand, earning per share, overall wealth of the shareholder decreases. So till now, equity finance is not worthful. Although financial risk is reduces by increasing the interest cover, but overall EPS become decreases. That's a point. But still there is a game that is about the gearing. For gearing, we required what? Debts, equity, and total. Debt plus equity. You have only 14 to 15 minutes to cover this, huh? To complete this question. For calculation part. Existing debts, it's 450. Existing debts is 450. If you go with equity finance, your debts remain same because you will arrange 360 from equity finance. Your debt will not change. And someone asks why interest not change? Interest not change because you add the finance with rights issue. Your interest becomes same. No change in debts, no change in interest. Is this clear? Reply me. But if you move towards the debts, so existing debts plus you will add 360. Total debts has become 810. Total debts has become 810. That's a point. What about the equity? What about the equity? To remember, we required market value. For debts, book value is equal to market value. Why? Because here debts is bank loan and new debts, it's marketable loan but moves trade with nominal value. I repeat, here the debts, all debts working are book value based because the existing debts 450, it's book value, bank loan, book value is equal to market value. But here examiner mentioned the new debts you will offer, although it's loan notes, it's marketable, it's tradable, but trade at book value. Nominal means book value. That's why with this question, I categorically mention debt book value is equal to market value. Debt book value is equal to market value. That's a point. Now what about the equity? We need to calculate equity market value. Equity market value. Equity market value. How to calculate equity market value? Equity market value. There are two possibilities. Number one, share price multiplied by number of shares. Number of shares. So now, what about now? Now share price is 1.2. So is equal to 1.28 800 960. 960 is equal to 960. But in case of debt issue, number of shares remains same. Number of shares remains same. In case of debt finance, 800 shares multiplied by 800. This is 800 shares. 800 shares multiplied by what? Earning per share. Sorry. In case of debts, share price is equal to EPS multiplied by PE. What is the EPS? What is EPS? Earning per share 0.2 multiplied by 8. That means 1.57. And what is the value of equity? Is equal to 1.57 into 800 shares. 1259. Or you can work out simply. That's profit after tax, equity value. Equity is equal to profit after tax multiplied by PE ratio. Profit after tax, how much is the profit after tax? 157.44 into 8. Same answer. Both ways. Means you don't need to calculate per share price. Just profit after tax multiplied by PE. Same case for equity. In the case of equity, what's the share price? Your examiner did the calculation with per share price. EPS, students, are you with me? 0.14 into 8. Here question mentioned that P becomes same. And equity, do let me know. In case of equity, how much the number of shares? How much the number of shares? How much the number of shares? 1200. The number of shares, 1200. 1374. Or you can calculate with this. Means profit after tax multiply by it. Same. Students, please do reply me. Are you with me? If you ask me, sir, if you are a student, what you will do? I will prefer simple. Profit after tax multiply by it. That's all. Profit after tax multiply by it. That's all. Equity market value. Total debt plus equity 1410. 1824.7. It's a total. Now, debt over equity. Debt divided by equity. 39.14%. Debt 450 divided by equity. This one. That's all. That's a calculation. That's the point. That is the total debt plus equity. And the calculation. The calculation is done. Make sure this calculation you need to cover within 14 to 15 minutes. That's why we need to work out within within 14 to 15 minutes. That's the point. So this is the calculation part. But before withdrawing the point about the calculation part, listen carefully. One thing you need to focus. One thing you need to focus. A very important thing that's need to focus. A very important thing. Students, we have to move towards the comment parts and have to mention the recommendation as well. Have to make the recommendation. So develop your mindset accordingly. Develop your mindset accordingly. Students, quickly, interest in gearing with the new project, interest in gearing, it's about financial risk. EPS is about return. So if any investor wanted to finalize the decision, so very important thing that need to consider return versus risk. If move towards debt side, obviously higher risk. If to move towards the equity, the financial risk will not increase. But on the other hand, return phase is equal important. Return means EPS. Here the case, if you compare from now versus debts, interest cover reduces. That means high financial risk. Gearing increases from 30 to 39. That means high financial risk. So that is about risk. But return from 0.15 to 0.2, return is also increasing. That's the one side of picture, now versus debts. But if you move towards the now versus equity and also compare debt versus equity, your interest cover increases and gearing become reduces. Overall financial risk reduces. But the problem is that here the return EPS with new project return become reduced. That's the reason more suitable with this case is about debts. So that is what a 30 seconds brainstorming before making the write-up or draft for part 3. Part 3. For part 3. Now come on. This is what about the part, the theoretical aspect. Now listen carefully. Now listen carefully. The theoretical content. First of all, I must say, before writing the answer, these are the points that you need to cover one by one. Students, one by one. Part A, number 1, comments and recommendation. You have 3 marks to work out. Out of that, you have total 5 minutes. For 3 marks, you have 5 minutes. And very specifically, 2 comments, 1 for debts, 1 for equity, and 1 comment about recommendation. Whatever we discussed just before the sheet, that about the brainstorming. That's a brainstorming. That's comment 1. Debts. Higher risk. Gearing increases, interest fall. But EPS also rises. That's something, develop the mindset. For equity, lower risk. Gearing falls. Interest cover improve. That means financial risk become better, but EPS reduces. If examiner mentioned recommendation, your answer will incomplete if you don't conclude your answer with the final words. What they should do. Obviously, the decision depends on shareholder attitude, but more specifically, the better is for debts. Here, the final decisions based on attitude of shareholder, the preference of shareholder. Are they required growth or safety? Safety means risk. And based on that, this answer you need to write. This is not the model answer. This is what the student support answer. This is student support answer. Student support answer. Student support answer. Using debt finance, increasing, this is the statement, increasing gearing 39% reduces interest 5.37 times. That means high financial risk. However, but EPS increase 0.2. That means increasing shareholder wealth. With this statement, you will get 1 mark. Always do the calculation and write the answer according to the marks. Do practice with the relevant working. Relevant means relevant calculation, relevant theory. Sir, how much I should write to get 1 mark? This one. In contrast, equity finance reduce gearing 24.7. Strengthen the, increase the interest cover. That means lowering the financial risk. But the drawback is lower EPS compared to debts. Compared to debts, that's 1 mark. Examiner mentioned comment. Here you mention comment. But examiner says recommend, so you need to mention recommend. Overall, loan notes means debt finance. Option, debt finance means loan notes option is recommended if shareholder accept high risk and wanted to get returns, but equity remains safer alternative if reduce the risk. That's 1 mark. You observe the last line. The last line, it's not absolute. If you just mention go for loan note, no. Incorporate some diplomacy. Here we are more preferring the loan notes, but equity is also considerable if you wanted to take, if you wanted to reduce the risk. Students, can you please reply me? Are you getting the point? How to draft the answer? Are you getting the point? How to draft the answer? This is what smart methodology to draft your answers. That's the point. Students, a part that we have completed, that's calculation and theory as well. Now we need to move towards the B and C part. But for this, we have to take 2 to 3 minutes short break. 2 to 3 minutes short break. Thank you very much. Okay, let's resume the session. And that is something about the B part. B part, the question is about discuss the problems associated with high level of financial gearing. 5 marks. High level of financial gearing. That's a 5 marks. So number 1, is this about the general question? Yes, it's about the general question. It's a very common question examiner examine in a way. But once again, before starting, you need to plan this question. So number 1, part B, problems with high level gearing. You have 5 minutes, 5 marks. That means total 9 minutes. It's not about something to detail paragraph, but you need to identify some points. So before highlighting, before entering to express the words, the point is about, first of all, brainstorm what are the points you will write. It's very simple. High level financial risk, having a chance or having a problem to become bankruptcy, which means not able to pay the interest and debts. So that's a problem. Agency cost means maybe you are at that case you are borrower, the lender make a restriction in terms of covenants, and the shareholder are reluctant to accept any covenants. Number 3, limited debt capacity. Debt capacity means once you get the loan, your future ability to arrange more debts, more finance may be restrictive. Obviously, increasing in finance cost, that means high financial risk. So once the company penetrate more debts, that will result having the high financial risk. So demand from high return, expecting high return from equity holder and from debt holder, both sides. So your cost in the right now, if you inject the debts, okay, but in future, it's may possible that equity holder demand higher risk. Obviously, debt holder required higher risk. That means the increasing finance cost of debts, cost of equity. Tax exhaustion, maybe you increase the debts, the benefit of tax from interest, may be exhausted. For example, tax authority says that, okay, we will provide you the tax advantage, carry 1 minus 3, and maximum $40,000. But if you inject more than debts, where the 40,000 you cross with 40,000 limit of the interest, so tax authority will not allow you the benefit of interest or interest as tax allowable expense. So that's called tax exhaustion. Higher the interest, higher the chances to become in a position for tax exhaustion. So the point is that at least 2 to 3 points you need to develop a mindset. And this is a very basic, very basic. For 5 marks, 3 to 4 good points. 3 to 4 good points. So here I have mentioned that for each point having 1 mark. So actually I drafted I've drafted that particular question in a manner, some conservative approach, that students must have to practice in a strategy to write more. Okay, so that's simple. Bankruptcy, as we discussed, debt requires interest, capital repayments. So in the difficult times, there must be met. So this might increase the chance of defaults and liquidations. Same for agency, that's restrictive covenants. The loan provider, the lender may impose strict conditions. The covenants like dividends, no new debts. So maybe shareholder are reluctant. That's reduce the financial flexibility. Debt capacity limits means if you add more debts with high gearing, so you have already pledged the assets as a collateral. So you have your capacity to raise the funds become limited. Higher finance costs, both debt and equity, because having more financial risk. Tax exhaustion, as I've discussed. That simple 5 points. You just write these 5 points. 1, 2, 3. Sir, is this necessary to make heading? No, not necessary. You just express your 4 to 5 ideas. That's a point. Further, the last one. The last one. Very specifically, you need to observe in a recent board meeting, the use of Islamic finance was mentioned as being another possible finance source, Islamic finance. As the nature of project and all the Gemgee company activities are eligible for Islamic finance principle. The board wishes to consider use of Islamic finance. Typical question about Islamic finance. But a condition, the board has agreed that in the Islamic finance arrangement should be similar to traditional debt. It's not about profit making, it's about debt basis with no profit sharing or management involvement or investor or Islamic bank. So here is the question about the Islamic finance, but very categorically, particularly mentioned Islamic finance is more related to debt finance. Very specifically, discuss 2 sources of Islamic finance that could satisfy the Gemgee company need for project taken into account for the board conditions. Do remember, like if we compare with the B part, C part, it's not generic answer, generic question. It's a specific question to the case. Reference of the Gemgee, more referenced with the traditional debts like this. That's a point. So although there are multiple more options with the Islamic finance, but 2 specific, you need to write 2 specific, murabaha and ijara. So very specifically, you have to write the answer that's resemble with the debt finance. No involvement of the investor or the lender, like the partnership model. So these 2 points that you can refer. First of all, that's a planning phase. That's 2 specific point. Murhaba. Sir, this is for 4 marks. What is the right strategy to write? 1 mark for definition, 1 mark for suitability. If any of the student just mention the definition, the student will get 1 mark. Ijara, 2 mark, 1 mark for definition, 1 mark suitability. So your brainstorming points are: number 1, 2 suitable sources, Muraba and Ijara. That's not like equity, it's more about debts. Explain and apply with 2 marks. Avoid Mudaraba Musharka. If someone mentioned Mudaraba Musharka, that's not relevant, irrelevant answer. Sometimes a student says that I attempted all the questions. Why I failed? I asked to the students, have you attempted as per the requirement? Student reply, no, I don't know, sir. So very important, read and understand and brainstorm. You need to draft answer that's relevant according to the marks, according to the requirement. So that's the answer. Student standard answer. Make sure for both description includes definition and suitability. For example, Muraba is about cost plus sales, where Islamic finance institutions, Islamic banks, purchase the asset. For example, if I required a car, so Islamic financing will not provide, I required finance for car. Islamic bank will not provide me the finance, but Islamic finance first purchase the car and sell to the company. For example, I required finance for 5 million. Bank will ask why you required finance 5 million. Bank, the company replied, we will require a car. So company, Islamic finance bank may offer you to purchase the car. For example, the car value 4.5 billion and addition the profit of 500,000. So, and then hand over the car to you. So what the benefit I have? Whatever the purpose of finance I have met the purpose. That's I have arranged the asset. Payment, and after that payment will be made with installments and ownership passes immediately. This is what about the description. But the point is that why suitable? This is suitable because it avoids interest and provides predictable payment terms. Same case, you have to mention for Ijara. Need to explain the Ijara and then explain why it's suitable. Why it's suitable. So that is how you need to draft your answer accordingly. That's a point. So that is all about the session. With this session, we have covered not only about attempting the question, either theory or calculation, but with exam standard and with the drafting technique that's supportive for the students. I hope it's very clear to you. Thank you very much and wait for the another session. Take care a lot. Assalamu alaikum.